It's fair to say that the world has changed since your last report was issued. How has the property market been impacted?
Well, yes, we're filming in my kitchen. The sudden and dramatic deterioration in economic and property market conditions since our last report was published only 2 months ago has been unprecedented. The onset of the COVID-19 pandemic and the resulting lockdown has impacted every sector of the Irish economy and real estate market, with sectors that have a high volume of social interaction impacted significantly more than others. It's fair to say that Ireland's caretaker government have been commendable during this crisis. They've acted swiftly and decisively, implementing a suite of supports and stimulus measures that will help Ireland weather the storm to some extent. However, with the economy unlikely to bounce back as quickly as was envisaged initially, and with the Department of Finance now predicting a 10.5% decline in GDP in Ireland in 2020, it is clear that additional supports for trading businesses and SMEs is now becoming an urgent priority. Every sector of the property market has been affected differently. Some transactions are proceeding, and there were several notable deals announced in recent weeks in both the occupier and the investment sectors of the market. However, for the most part, campaigns have been curtailed for the foreseeable future, which will result in significantly lower transaction volumes being recorded in Q2 in all sectors. The lack of transactional evidence will clearly pose challenges from a pricing perspective.
How has the office market been impacted?
Take-up in the Dublin office market in Q1 reached almost 100,000 square metres, which was 50% higher than the 5-year average for the quarter, boosted by the carryover of several transactions from 2019. The true impact of the COVID-19 lockdown on transaction volumes in this sector won't manifest until Q2 figures are compiled at the end of June. Many office leasing transactions have understandably been put on hold indefinitely as occupiers put off decision making and adopt a wait-and-see approach with regard to expansions and relocations. There are a number of sizable transactions in legals, although the legal process and leasing process has slowed considerably, with prolonged periods now from exclusivity to completion and closing being experienced. Transactions that are progressing are for the most part triggered by upcoming lease events, and most are relatively small. According to our research, approximately 6,000 square metres of office accommodation has been leased in the capital since the COVID-19 lockdown commenced. While some office landlords may be asked to consider rent abatements and lease re-gears over the coming weeks and months, the most obvious change likely to be witnessed in this sector is some outward movement in rent-free periods in leases, and in some cases the deletion of break clauses in exchange for some element of rent-free.
Is oversupply something we should be concerned about?
I think the shutdown of non-essential construction sites and their ultimate reopening on a phased basis will constrain the development pipeline, and this will push out the delivery of some office projects by at least 3 months, insulating the market to some degree from the threat of oversupply, which would typically be a concern in a period of downturn such as this. Once office occupiers have got their core businesses back on track, we believe that expansion and relocation decisions will reignite, led for the most part by the domestic market. Clearly, from an Irish perspective, the US economic recovery trajectory will be a hugely important consideration on the basis that this is where much of the multinational decision-making emanates.
Do you think that more people will work remotely in the future and impact on demand for office buildings?
Not necessarily. It was interesting to note in the recently published Programme for Government document that the public sector employers are now being encouraged to facilitate staff working remotely at least 20% of the time. I think enforced remote working over recent months might encourage some occupiers to consider their future office space requirements, and we are likely to see increased incidence of some employees working 1 or 2 days from home going forward. But the reality is that office space will still be required. In fact, it's expected that density rates in offices might reduce to facilitate appropriate social distancing.
What about the industrial and logistics sector?
Although transactional activity has for the most part been curtailed in recent weeks in the industrial sector, with several industrial and logistic requirements as well as a few large land transactions now on hold, there has been a spike in short-term requirements from the grocery, parcel delivery, logistics 3PL and pharmaceutical sectors, which is directly attributable to COVID-19. Internet and remote working providers have also clearly seen a spike in activity in recent weeks, which has increased utilisation rates within data centres, and it is likely to support demand for cloud-based services and data centres in due course. Indeed, data centre users were responsible for 2 large land acquisitions that were completed in the Dublin market in the last couple of weeks. Just as in the office sector, with non-essential construction halted and sites likely to reopen on a phased basis, it is inevitable that the delivery of new industrial and logistics stock will now be delayed somewhat. This will put further pressure on the availability of prime accommodation in the capital, and for this reason, at this juncture at least, we're not expecting any notable deterioration in headline rents in the industrial or logistics sector of the market.
How are retailers coping?
Other than the grocery and pharmacy sectors, which have witnessed significantly increased activity during March and April, the retail sector of the property market has clearly been very negatively impacted by the COVID-19 lockdown, with all non-essential retailers forced to close their physical stores during the last 2 months. This has encouraged some retailers to accelerate the rollout of online facilities, and in this regard, many food and beverage retailers have availed of a government exemption from planning permission for takeaway and delivery use during the lockdown period. Unfortunately, there has been considerable negative news about retailers who may or may not reopen their Irish stores. Many retailers are not in a position to pay rents, service charges, and other costs in the current climate. Many trading businesses have therefore been calling for support from landlords in the form of rent adjustments, rent abatements, or lease restructuring to help them to weather this crisis and to be in a position to reopen in due course. Every situation has to be considered on a case-by-case basis. Collaboration between landlords, tenants, and indeed their financiers is critical, while some form of government support for this sector of the economy is now clearly merited. With retailers understandably focused on their core businesses right now, transactional activity in the retail property market is expected to remain subdued for the foreseeable future. The expectation is that some retail vacancies will start to increase, meaning retail rents in some locations could come under pressure in the medium term.
What is the new normal for the retail sector going to look like?
Well, based on what our Asian colleagues are telling us, the expectation is that when stores are allowed to reopen, this will occur on a phased basis, with some sectors of retail permitted to open sooner than others. In any event, the new normal is expected to look considerably different, with footfall likely to remain compromised due to a combination of weaker consumer demand, restricted trading hours, restricted customer volumes in store, and social distancing requirements that are likely to remain in place for quite some time.
Has the investment market ground to a halt?
No. With investment spend of about 1.3 billion having been recorded in the Irish market during the first quarter, it is encouraging that despite the COVID-19 lockdown, momentum has continued in the investment market in April, with a number of high-profile investment transactions having completed in recent weeks, including several sales that CBRE were involved with, including the sale of the Bishop Square office building for €182 million, the acquisition of a multifamily investment at Mount Argus for €93 million, and the sale and leaseback of the Clayton Hotel Charlemont to Decca for €65 million. All of these deals have closed in recent weeks. While a number of other investment transactions are currently in legals and expected to complete in the coming weeks, most sales campaigns in the investment space are unfortunately now delayed, as investors who are unable to travel to conduct meetings or building inspections in any event adopt a wait-and-see approach. Encouragingly, investor demand for Irish assets remains strong and there's considerable liquidity, meaning that when we are through this crisis and sales campaigns recommence, market activity is expected to rebound quickly in this particular sector of the market.
Is there likely to be an impact on pricing?
Not unlike the rest of Europe, the Irish investment market will be largely frozen for the next couple of months. The lack of transactional evidence would clearly pose challenges from a pricing perspective. We are expecting to witness a flight to quality, however, with particular demand for core assets once trading activity recommences. Pricing for core product is unlikely to alter to any great degree, but core plus and opportunistic assets will be more susceptible to a potential outward movement in yields over the coming months. Any movement in yields will be dependent on the availability and cost of debt, and of course, the strength of underlying occupational markets. Against this backdrop, the quality of underlying income, the sustainability of cash flow, and the availability and pricing of debt will become increasingly pertinent. The focus for the foreseeable future will be preparing assets for sale once liquidity returns, with particularly strong appetite anticipated for office, industrial, and residential investments.
What about the multifamily market?
At the beginning of the year, the biggest concern for investors in this sector was the potential imposition by Ireland's new administration of some form of residential rent control. However, once the state went into lockdown as a result of COVID-19, leading to an unprecedented increase in unemployment, rent sustainability became a much more pertinent concern. The Irish government acted quickly in enacting legislation to ensure that residential rents could not be increased or tenants evicted for a 3-month period, and it now looks likely that this period may be extended. In the last couple of weeks, holders of residential assets have been focusing attention on stabilising income and sustaining occupancy within their schemes. With some improvement in supply anticipated as short-term lets convert to longer-term leasing and other units come available, the government now appear unlikely to pursue rent control as a policy in the short to medium term. Just as in every other sector of the market, transactional activity in the multifamily space is expected to fall significantly during Q2 before picking up from Q3 onwards. A number of transactions that were well advanced are reportedly progressing well. Meanwhile, several other sales campaigns have now been put on hold until such time as the sizable capital that's targeting this sector is in a position to travel and to deploy later in the year. We expect that investors will continue to invest in the multifamily sector when we exit this period of uncertainty, on the basis that the fundamentals of the Irish market compare very favourably with European counterparts.
Is pricing for multifamily holding up?
Yes, despite the challenging economic backdrop, pricing for prime multifamily assets remains stable at 3.75% at this juncture. Indeed, pricing in this sector has for the most part remained stable right across Europe in the last couple of weeks, with residential generally showing more defensive characteristics than any other sector of the market. There is a possibility, of course, of some price softening in due course, but this will depend on the depth and duration of the current crisis and the extent to which employment and wages and ultimately rents are affected longer term. We could, however, see some differential emerging in pricing for stabilised stock versus forward commit transactions.
Have land transactions also been impacted?
Yes, as in other sectors of the property market, many land transactions have been put on hold indefinitely, with the bid dates on most campaigns now pushed out until later in the year. This includes the former Ainger Street DIT campus on 2.5 acres in Dublin city centre, which CBRE are marketing and guiding €110 million for. The appetite for sites is hugely dependent on the availability and cost of funding. We expect to see some downward pressure exerted on land values in the short to medium term as a result of the current uncertainty. With Irish banks relatively well capitalised going into this crisis and in a position to offer a certain level of forbearance, it will be those sites that are funded by alternative lenders that are most vulnerable if this crisis continues for a considerable period of time. This could lead to an increase in the number of sites being offered for sale in the second half of 2020, in turn offering opportunity to those that are in a position to deploy capital. We expect to see a myriad of different structures emerging in this sector over the coming months, with developers and other parties increasingly likely to consider joint ventures, public-private procurement and profit-sharing arrangements in an effort to secure sites and conclude transactions.
What about the promised referendum on land prices?
The recently published Programme for Government document alluded to the possibility of revisiting recommendations of the Kenny report, which was actually published the year that I was born, and holding a national referendum to give the state power to cap land prices to reduce the delivery cost of new home product. However, holding a referendum to tackle land prices would prove difficult, if not impossible, to implement, and would likely be challenged on constitutional grounds.
How badly has the hotel sector been impacted?
It's fair to say that the hotel sector of the economy is one of the most exposed to the current COVID-19 lockdown. We've seen a notable decline in occupancy and evidence since the second week of March, and most hotels are now closed. This has inevitably had huge negative repercussions for the hotel property market. While some existing sales mandates are continuing, many hotel sale campaigns have now been put on hold. The sector clearly faces many months of severe disruption. Some hotels have been repurposed in recent weeks, such as the 750-bed City West Hotel, which is now being used as a COVID-19 isolation centre. But many others will unfortunately remain closed for the foreseeable future, and it remains to be seen what the impact will be to measures such as RevPAR and occupancy once these hotels reopen and markets ultimately stabilise, although domestic business is likely to prove supportive until such time as the international tourism and international business improves once travel restrictions are lifted. At this juncture, it's not clear when hotels will actually be in a position to reopen for business.
Are you still seeing demand for hotel properties?
Interestingly, what we're actually witnessing is stronger demand for hotel development projects than standing stock at present. This demonstrates the resilient nature of the hotel sector, as well as investor and hotelier confidence of a return to strong trading conditions in due course. Indeed, the recently announced sale of the Clayton Charlemont Hotel in Dublin 2 to German investor Deka in a sale and leaseback transaction for €65 million provided a really welcome boost to the market in the last couple of weeks, signalling underlying confidence in the hotel sector over the longer term, despite the current situation.
Are additional supports necessary for the hotel sector?
Yes, while hoteliers have been appreciative of the government supports to date, including the wage subsidy scheme, longer term, the industry will require additional assistance in relation to costs such as VAT, rates and insurance. Similarly, the licensed trade has been particularly badly impacted by COVID-19 restrictions and will also require additional supports to enable them to survive until such time as they can safely exit lockdown.
Presumably, the Cork market has also witnessed a slowdown.
Yes, activity in the Cork property market has slowed considerably in recent weeks as a result of the COVID-19 lockdown. As we have seen elsewhere, transactions that were well advanced are proceeding, albeit at a slower pace, while campaigns that were due to commence have now been put on hold until later in the year. As we've been reporting for some time now, we are witnessing strong appetite for many of the new office buildings that are at various stages of construction in Cork, with particular demand from existing companies looking to expand their operations in the city. And in this regard, it is encouraging to see that the John Cleary Group have in recent weeks confirmed lettings to Qualcomm and Sophos in the Penrose Dock development in the city's inner docklands.
So where do we go from here?
The Irish economy and its real estate market entered this crisis from a position of relative strength. Factors such as the structural imbalances between supply and demand, Ireland's favourable demographics, and Ireland's attractiveness as a destination for occupiers remain unchanged and will continue to prove supportive of investment in the Irish real estate sector post-COVID. Provided the outbreak is brought under control in a reasonable time frame, and provided we follow the trajectory witnessed in Asia, our house view at this juncture is for a rebound in activity in the Irish commercial real estate sector during the second half of 2020, led initially by the investment sector of the market, where there is considerable investor equity in a position to deploy once assets are released for sale in due course. It will, however, take longer for the occupational markets to rebound. The depth and duration of the pandemic will ultimately dictate the extent to which the real estate market is impacted, and it is clear that in every sector of the market, the new normal will be a very different place indeed.